Sydney's auction clearance rate just came in at 76% for last weekend. But at the same time, fresh ABS data shows new dwelling approvals fell almost 15% in December, with multi-unit projects down nearly 30%. So we're seeing strong buying, but weaker building. In this week's updates, let's unpack what tension actually means for you as an investor. These numbers aren't coming from Twitter hot takes. They're from Domain's auction results for the week ending 7th of February and updated on the 12th of February. The ABS lending indicators and building approvals releases that dropped on the 9th and 10th of February. And a new commentary from SQM Research, ANZ, and the big banks, and a fresh regulatory wrap-up from realestate.com.au and Mortgage Choice this week. Most headlines will give you one of these in isolation. Here, we're going to stitch them all together so you see the cause and effect story that's actually driving the market right now. And later in this video, there's one moment to stick around for because we're going to bring all this together. The surge in new investors and first home buyer loans, the drop in apartment approvals, the latest rental vacancy squeeze, and the big banks' new rates and price forecasts, and show you the single pressure point that really matters if you're buying in 2026. It's not what most people are obsessing over. So if you want to invest without being whipsawed by every headline on rates, watch through to that everything joins up section. That'll be your mental model for the next few months. All right, let's start with lending because that's where demand shows up first. This Tuesday, the ABS released the lending indicators for the December quarter. The headline, housing credit momentum picked up into the end of 2025. In seasonally adjusted terms, the number of new loan commitments for dwellings rose 5.1% over the quarter. The value of those loans jumped 9.5%. So borrowers aren't just taking up more loans, they're also taking up bigger ones. So if we break that down even further, looking at owner-occupier loans, the numbers are up 4.8%, and the value of owner-occupier loans are up 10.6%. Looking at investor loans, the number is up 5.5%, and the value again is up 7.9%. And here's the kicker. First home buyer loans rose 6.8% in number and a huge 15.5% in value over the quarter. The Housing Industry Association came out this week and said that 31,780 first home buyer loans in the quarter is the strongest performance in almost 4 years, and tied a lot of that to the expansion of the government's 5% deposit scheme from October. So despite higher rates, investors are still coming back. First home buyers are swarming the bottom end of the market, and average loan sizes are rising. Now, layer on policy, REA.com.au and Mortgage Choice ran a big piece this week on 9 big changes for buyers and renters in 2026. And the very first one is APRA's new cap on high debt-to-income lending finally biting. From this month, banks are not allowed to have more than 20% of new loans going to borrowers with a debt-to-income ratio of 6 or above, across both owner-occupiers and investors. That rule was announced back in November, but it's only just taking effect now. The December quarter lending surge you're seeing in the ABS data is pre-clamp. So, credit growth into December was strong. The clamp on riskier loans is only now starting to shape the next few months of approvals. Now, what are the banks themselves expecting? Following the RBA's 25 basis points hike to 3.85% on the 3rd of February, ANZ, NAB, CBA, and Westpac have all updated their rates and price forecasts. One summary piece this week laid it all out like this. CBA and Westpac now tip another 0.25% hike as early as May, which would take the cash rate to 4.1% if that happens. ANZ expects capital city home prices to rise about 4.8% in 2026, with Sydney and Melbourne only doing 2 to 3%, and smaller capitals like Brisbane and Perth outperforming on the back of very tight supply. So the big picture demand story this week is money is still flowing into housing, especially from investors and first home buyers. Regulators are starting to lean harder against high DTI borrowings. And banks still see price growth, but slower and more uneven. And they're openly talking about at least one more rate rise this year. Hold that in your mind, as credit is still fueling demand, but the screws are tightening at the edges. Next, let's look at how that demand is showing up on the ground, at auctions in particular. So Domain's updated auction results for Sunday 1st of February to Saturday 7th of February has come through on the 12th. So across the capitals, Sydney's clearance rate is at 76%, with 794 auctions scheduled, 590 reported, and 447 sold. Melbourne is at 63% clearance rate, with 660 scheduled, 566 reported, 359 sold. Adelaide had a 70% clearance rate, which is off 151 scheduled auctions. Canberra, 63% clearance rate from 157 scheduled, and only 142 were reported. Brisbane had a 48 clearance rate, which is basically a coin toss, 50-50, from 126 scheduled auctions. So there are two key reads from that. Sydney is still running very hot. In the mid-70s clearance on a higher rate environment tells you there's depth of demand, especially in quality, well-located stock. Brisbane is now clearly two speeds. Under 50% clearance rate suggests buyers are much more price sensitive at the margins, consistent with stretched affordability after big gains. Now, let's zoom out from last weekend to the January price data. The latest home value index data released in early February showed national dwelling values are still up 0.8% in January, which is actually slightly faster than December's gain. Every capital city and rest of state region recorded an increase. And the standout pattern is the lower quartile of the market is outperforming, while the upper quartile is barely moving. And that lines up almost perfectly with ABS's lending we just talked about. First home buyers and investors are active at the cheaper end, but higher end buyers are the more rate sensitive and more constrained by APRA's high DTI caps. So demand is still there. It's still concentrated in affordable price points and visible in both loan data and auction clearances. Now, what happens when that demand runs into limited rental stock and falling approvals? This week, multiple outlets picked up on SQM Research's latest vacancy data for January. The short version, national residential vacancy fell to 1.2% in January, which is down from 1.4% in December. That's about 37,600 vacant rentals nationally, down from roughly 43,800 a month earlier. So city by city, vacancy rates are Sydney at around 1.5%, Melbourne's at 1.7%, and several smaller capitals, Perth, Adelaide, Hobart, are still under 1%. SQM and others have been very clear on what that means. Anything under 2% is tight. Anything under 1% is chronic shortage territory, going upward pressure on rents. December's slight softening in vacancy, up to 1.4%, was largely seasonal. Lots of lease churn at the end of the year. But the fact that January has already tightened back to 1.2% says the market hasn't structurally loosened at all. Now, add the construction side that dropped on 9th of February. The ABS building approvals released for December showed total dwellings approved fell by 14.9% in the month to 15,542. Multi-unit approvals, which are apartment, townhouse, etc., plunged by 29.8%. And detached house approvals actually rose slightly by 0.4% to 9,487 approvals. In trend terms, approvals have flattened, then turned down. December's trend estimate fell 0.2% after a modest rise in November. So what you have is rental markets are still very tight, with vacancy back near 1%. New supply, especially apartments, falling sharply on the approvals pipeline. There is still some positive noise on the policy side though. So Treasury updated its social and affordable housing page on the 10th of February, confirming that HAFF round 3, which is affordable housing, opened in January, is targeting 21,350 social and affordable homes across 4 streams: First Nations, housing diversity, state and territory, and partnerships at scale. And a separate progress update late last year showed the government is on track for more than 55,000 social and affordable homes by mid-2029 through the Housing Australia Future Fund and related programs. But these are multi-year pipelines. They don't solve the immediate 2026, 2027 rental squeeze that current vacancy and approvals are pointing to. So on supply this week, very tight rentals confirmed again. Fresh evidence of a December drop in approvals, which are driven by units, and policy pipelines ramping up with long lead times. Now, tie that into the rule changes and grants that directly change behavior in 2026. On February 12th, realestate.com.au and Mortgage Choice published a wrap-up of 9 big changes coming for Aussie home buyers and renters in 2026. A few that matter for investors and serious upgraders are: number one, APRA's high DTI limits are now live. We've touched on this already. No more than 20% on new loans can be to borrowers with a DTI of more than 6. That hits investors and high-income borrowers who are stretching harder to chase growth. 2, new home building and planning reforms. The article pointed to a wave of planning tweaks aimed at speeding up new builds. The federal government's plan to sell off large defence land holdings for housing, New South Wales easing certain groundwater licence rules that have been slowing down approvals, and South Australia releasing 6 new structure plans showing where 43,000 new homes could be built over the coming decades. This is all supply positive, but again, slow burn rather than immediate stock. 3, grants and concessions quietly expiring. Some key timelines were flagged here. So Queensland's $30,000 first homeowner grant for new builds is due to close in June 2026. Victoria's off the planned stamp duty concessions on apartments and townhouses run until October 2026. The Northern Territory's homegrown build grants have been extended out till September 2027, giving that market a longer runway of incentive support. These create mini deadlines that can pull demand forward into certain segments and states. 4, renter side reforms. There were 2 notable ones this week. So Victoria is set to introduce a portable rental bond scheme later this year. Renters can roll an existing bond straight into the next property instead of finding thousands of dollars upfront again. Tasmania is strengthening pet rights for renters next month, putting it more in line with the eastern states. These don't change yields overnight, but they shift the balance of power slightly towards tenants and are part of a broader multi-year trend. 5, capital gains tax discount speculation. The article also highlighted that the CGT discounts is back in the firing line ahead of the May federal budget, with new Parliamentary Budget Office numbers showing the current 50% discount on long-term gains could cost $247 billion over 10 years. So what's important here is that no changes have been announced yet. This is all speculation, debates, and not policy. But what it does tell you is that the political pressure to tweak investor tax settings is rising, and CGT is on the list of possible levers again. Finally, on the support for buyers side, Housing Australia's media section this week highlighted that Australians have begun moving into homes purchased under the federal Help to Buy shared equity scheme, which opened late last year. Combined with the expanded 5% deposit home guarantee scheme and the surge in first home buyer loans in the ABS data, you can see how a policy is actively pulling demand into the lower quartile price buckets. So that's the stack. Credits up, especially for investors and first home buyers. Auctions are solid, with Sydney hot and Brisbane a little bit patchy. Rents are tight again. Approvals are falling for units. And policy is simultaneously boosting some forms of demand and trying to rein in risk overall. So let's pull all of this together. When you line up this week's data, a few contradictions start to jump out. Right? The first is demand is still resilient. Loans for dwellings are still up 5.1% in the quarter, right? With overall value increasing by 9.5%. First home buyer loans are up 15.5% in just 3 months. Sydney auction clearance at 76% and Adelaide is at 70%. Supply is not responding quick enough. National vacancy is back down to 1.2% in January after a brief seasonal lift. And December, building approvals are down 15.9%, with multi-unit approvals off by nearly 30%. And policy is pulling both ways. APRA is tightening at the margin with high DTI caps. The RBA has already hiked to 3.8%, and big banks now see at least one more rise as likely. At the same time, the Help to Buy scheme, expanded deposit schemes, and expiring grants are pumping demand at the low end. So what's the real aha here for investors? It's this, all right? The risk in 2026 is less about a sudden collapse in prices and more about a slow grind in borrowing capacity and cash flow, while structural undersupply keeps pressure under prices and rents. So in other words, near term, the market still has enough demand and not enough supply to support prices, especially in affordable segments and undersupplied capitals. But each incremental rate rise and each extra layer of credit regulation erodes how far buyers can stretch and how comfortably they can hold. Investors who max out the borrowing at high DTI ratios today, rely on thin cash flow margins in very low yield markets, and assume long-term CGT settings will never change are the ones taking the most risk in this environment. The flip side, investors who focus on solid yields, tight vacancy areas, and borrowing buffers that still work if rates edge up another 25 to 50 basis points are positioning themselves to survive regulatory and rate noise while still benefiting from the underlying supply shortage. So this week isn't bullish or bearish. It's a picture of competing forces. Credit is still flowing, approvals are still dropping, rents are tight, and policy trying to lean against overheating without killing construction completely. Now, let's cut through the noise and call out what didn't move in the past 7 days, because stability matters too. So looking at the cash rate, so there are no new RBA meetings this week. So the cash rate is still 3.85% after the 3rd of February rate hike. Market pricing and bank forecasts are broadly unchanged, high for longer, with a risk of one more hike by mid-year rather than cuts. 2, serviceability buffers. APRA's 3% serviceability buffer remains in place on top of actual mortgage rates. That continues to cap borrowing capacity and is a big reason why loan values aren't exploding even faster. 3, migration and population settings. Look, we don't have any new ABS migration data or major policy announcements this week. So the story remains here. We still have elevated population growth, especially into Sydney, Melbourne, and Brisbane, against weak new build numbers. And that takes us to construction sector stress. There's no fresh insolvency stats or major industry bailouts this week, which is good. Input costs and labor constraints are still elevated, which helps explain why multi-unit approvals fell so sharply in December. So why does this stability matter? Because it tells you that the pressure cooker environment, so high demand relative to supply, under tighter credit and rating settings, is still in place. Each new data point we've covered this week is adding pressure. It's not actually releasing it. So looking ahead, here's what's worth having on your radar. Not to react instantly, but to interpret in context. So firstly, the RBA February minutes. So the RBA met, as we all know, 2nd to 3rd of February, right? Minutes are due roughly 2 weeks later. So expect them around the 17th of February. What you should watch out for is how much weight they put on the housing rebound in 2025 to 2026. Whether they explicitly flag further hikes as likely or just possible, and any comments on rental inflation and construction constraints. 2, early February auction volumes. This week was the first proper ramp up in auction activity. Watch whether clearance rates hold in the 70s in Sydney and high 60s in Adelaide as volumes build, or whether they slip back down as more stock hits. Thirdly, any pre-budget housing tax signals. With CGT discount speculation now hitting mainstream consumer prices, keep an eye on Treasury speeches, think tank reports, and leaks around the May budget. You're not looking for panic headlines. You're looking for repeated, consistent signaling that a specific reform, like a tiered CGT discount, is being seriously prepared. And 4, further detail on HAFF Round 3 allocations. As Housing Australia and Treasury release more detail on which projects are being backed under the HAFF Round 3, pay attention to which regions and segments, so social versus affordable, are actually getting funded. That will tell you whether some supply pressure might ease slightly from 2027 onwards and where it probably won't. So look, if this kind of data-driven weekly update focused only on what actually changed helps cut through the noise, hit the like so YouTube knows to show it to more serious investors, and drop a comment, and don't forget to subscribe. Now, if you're listening to all this and thinking, I get the data now, but I still don't know what it means for my next purchase, my borrowing limits, and my risk, that's exactly where Investor comes in. At Investor, the focus is turning this kind of weekly noise into a clear 10 to 15 year property strategy. Stress testing your plan against higher for longer rates and tighter lending rules and ongoing supply shortages. Helping you decide what to buy, where, and in whose name or structure so that you're not just banking on capital growth and hoping policy doesn't move against you. Here's what you can do next. Use the link in the description to book a free 30-minute strategy call. On that call, you'll walk through your current portfolio or starting position, how this week changes in lending, rents, approvals intersect with your borrowing power and cash flow, and the 1 or 2 big decisions you should focus on before you buy, sell, or refinance anything. Just a structured conversation, so you're not making 6 or 7 figure decisions purely off headlines about options, rates, or CGT. Don't forget, if you want the next 5 to 10 years of your investment to be driven by deliberate strategy rather than reaction to every RBA meeting, hit the link, book a time, get some clarity on how to position yourself in this kind of market. Because honestly, data will keep changing every week. The question is whether your plan is solid enough to handle it. Thank you for watching.